Good morning, everyone, and thank you for joining Counselor Buchanan and Mitchell this morning for another professional education session. Today's presentation is entitled How to Choose a Financial Advisor, Strategies to Help You Make the Best Choice Possible. And our presenters during this 1 hour session are Judy Barnhard and Alex Seleznev. Judy is a Senior Vice President at Counselor Buchanan and Mitchell and a Director of the firm's Professional Services, Wealth Management, and Financial Planning Services Group. She's also a Senior Advisor and a Chief Compliance Officer at MBI, the firm's financial advisory subsidiary. In her role as a CPA and a certified financial planner, Judy consults on income tax preparation and planning, retirement planning, cash flow and budgeting, risk management, and estate planning. She is a regular presenter for CBM and is next scheduled to present at a February 23rd session entitled Medicare and Medicaid, What Should I Know Now and in the Future? Alex Seleznev is a senior advisor at CBM. He leads the firm's investment management division and is co-founder and chief operating officer of MBI. Alex is a certified financial planner and a chartered financial analyst. He is a regular co-presenter at the firm's market update sessions, which are held every other month. He is also scheduled to present on February 23rd in the same Medicare and Medicaid session in which Judy will also serve as his co-presenter. Once again, thank you for joining us. We would ask that you please keep your video off as a courtesy to our presenters. Thanks to those of you who have also submitted questions during the registration process. Unlike in previous sessions, we may be answering questions throughout the duration of today's presentation rather than at the end. If other questions do come up, however, the chat box is available to you and will be monitored throughout the session. So we would encourage you to submit your questions for Judy and Alex. We will be sending the presentation slides to all attendees after this session, and the session is being recorded. With that, one last thing, if you are participating by your phone, and I see your phone number on the screen, please email me your name and your phone number so I know who you are. We can get you the slides. And with that, I'm going to turn it over now to Judy and Alex.
Hi, good morning. I'm Judy Barnhard. I want to welcome you to our presentation today. When Alex and I were tossing around ideas about webinar topics, this came up. This is our first time that we're giving this specific presentation, and we really want it to be transparent. That is our objective. We find that a lot of times we talk with clients, and they don't necessarily know how fees are being paid, how expensive maybe certain investments might be. And they don't really understand the alphabet soup of the different credentials and so forth. So I just wanted to reiterate, we want this to be transparent and educational. We welcome questions in the chat box. Sometimes we have a lot of technical information to go over and we don't have time, but this one, we really would like to be interactive. So to the extent that you have questions you want to pose, go ahead, and Alex and I will be kind of monitoring the chat box to try to get those questions answered for you. We're also not making any endorsements in this presentation or any specific examples. We're really talking about, the whole kind of holistic approach to financial planning and how to choose a financial advisor for your particular situation. Okay, so with that, what services do you need? I wanted to start by saying many of us have played the game of life. And the game of life, as you might know, has the start box. You go to school, you get your car, you add a family, you get a career, and eventually the road either ends at shabby acres or millionaire estates. And really, a financial advisor is someone that you would have a connection with throughout life's challenges that surely will come in twists and turns. So here I'm listing out, some of the events and transitions in life that clearly is very helpful to have a financial advisor help you kind of think through the decisions. Getting married. Well, of course, getting married could be when you're in your 20s. It could be a second marriage. It could be a silver marriage. But generally, when we talk about getting married, we are saying, okay, let's show and tell. Okay, let's make sure that the couple discloses to each other all of their assets and liabilities. What kind of debt do they have? Maybe, student debt, maybe credit card debt, maybe they've had bankruptcies. But do the share and tell, prior to getting married. And where a financial advisor can help you is put together a personal financial statement, and they can also help you decide how to address debt management if in fact, there is debt being brought into the marriage. Can help with budgeting, obviously a spending plan, particularly with young couples getting married. Do they have a joint account? Do they keep separate accounts? How do they pay, bills that are for the married couple? And of course, goal setting and tax consequences of filing married, filing joint, or filing separate, or single. So those are all very important aspects of the getting married question that a financial advisor can help you with. Starting a family, of course, that brings into the question of life insurance. Again, budgeting for college, and perhaps that's the time when you would need a will prepared, or to name a guardian should anything happen for young children. Getting divorced, of course, another major life event. Financial planners can help you prepare a schedule of assets, and also decide, what would be an equitable division of those assets, of course, working alongside with attorneys. Alimony and child care decisions, budgeting, of course, goes into that. And then the tax consequences. A lot of times when couples get divorced, the tax consequences are going to be very different. They might be, they may be getting a house that would, in the future be sold and have a taxable gain or whatnot. So we try to make sure everything is tax affected when we're helping people negotiate a divorce. Approaching retirement, that's probably where we spend most of our time, is helping clients decide, do they have enough money to retire? And we do retirement projections, various different scenarios. What if they move out of state or to a lower cost state? How long should they continue working? When can they stop working? So there's just so many different variables when looking at the approaching retirement decision. And ideally, we really like to recommend that financial advisors work with individuals approaching retirement at least 10 to 15 years out, so that we can right the ship, so to speak, if anything needs to be addressed at that point in time. Passing to the next generation, of course, estate planning, how inherited assets are taxed, how assets are titled, will there be probate, how to avoid probate. Do you want to be doing charitable giving? Maybe consider charitable trusts. Obviously, all the gift tax issues. So this is an area particularly of concern right now, with proposals to change the estate tax exemption at the federal level. And of course, DC has already lowered its exemption to $4 million. So this is something that we're working with clients a lot. Death of a loved one, of course, preparation of decedent returns. It's not easy. You really have to separate out assets, have to schedule of assets of who owns what. There may be trusts and estate issues involved. Again, another summary of assets, budgeting and cash flow considerations for the surviving spouse. And then inheriting wealth. Often, a financial advisor will help clients who's, they've inherited a significant amount of assets and they don't know what to do with it. They don't know how to invest it. They don't know if they should use it to pay off debt. They don't know the tax implications of, is it capital gains, ordinary income? Will there be any tax? So these are all events and transitions that definitely would warrant the consideration of using a financial advisor to help you through those decisions. Next slide, please. So not all financial advisors offer every service listed here. Some advisors may have significant knowledge in one area and not necessarily knowledge in all areas. And often financial advisors will seek out and use, the expertise of other financial advisors. So we're actually a pretty close network group. There's times where we may have conflicts of interest where, we refer work to other financial advisors because we have an inherent conflict, and vice versa. So it is definitely synergy amongst the financial planning community to help one another to meet the client's goals. Next slide, please. So think of the financial advisor kind of in the middle as the ringmaster, so to speak. They're responsible for the overall financial planning for that client. And they're going to need obviously expertise in investment advice, making specific investment recommendations, reviewing portfolios, looking at asset diversification. They will need legacy or charitable planning expertise in terms of passing the next generation, which often then, a financial advisor will bring in an attorney to help the client in this situation, particularly if they want to establish charitable gift annuity trusts. Tax planning, of course, CPAs for tax return preparation, but financial planners also are involved very much in planning, tax planning, and running different scenarios, cash flow analysis, and again, consideration of tax efficient investment in terms of capital gains versus ordinary income that's spun off from the investments. Estate planning goes along with the legacy and charitable planning, your wills, trusts, gifting, power of attorney, healthcare directives. All of that would want to be part of the estate planning that's provided to the client. Divorce litigation obviously is pretty specialized, but helping clients with the equitable division of assets, budgeting, and cash flow, and of course college planning. 529 plans or Uniform Gift to Minors Acts, or how expensive college is going to be. So helping clients consider all of that and start planning and saving from the get-go. So I would say when choosing a financial advisor, you want to consider obviously what your needs are, and you also want to match that to what their expertise is. Next slide, please. So, credentials. This is where I was referring to alphabet soup. Just like you would with going to see your doctor, which also many doctors have lots of different acronyms after their name. You'll find financial advisors with many different acronyms. So here are the ones that are primarily, related to financial planning. Obviously, the Certified Financial Planner, the CFP designation, it's a formal recognition of expertise in the area of financial planning, covers taxes, insurance, retirement, estate planning, also risk management. It does require a bachelor degree or higher. Generally takes 18 to 24 months to study for, and it's a rigorous 6-hour exam. So that's the CFP. A CFA is the Chartered Financial Analyst, a globally recognized professional designation that measures and certifies the competence and integrity of financial analytics. This is a 3-level series, 3 levels of exams. It's extremely difficult. Generally takes 4 years to earn. It is really kind of the cream of the crop in terms of designations for financial analysts. They cover security analysis, statistics, economics, portfolio management, and much more. The FINRA series, you often see these with larger brokerage companies when they bring on young financial advisors. They sponsor them with a FINRA series licenses. The Series 7 is a license for general securities representatives. The Series 65 is specifically for investment advisors, and the Series 66 is what you get after you become a Series 7, and it basically allows you to transact securities business. So it's very much focused on securities and portfolio management. The Certified Investment Management and Analyst is also focuses on investment consulting, risk assessment, and portfolio management. Then there's the Personal Financial Specialist. This is offered by the American Institute of CPAs. It's only allowed for credentialed CPAs, and it essentially covers many of the areas that the CFP has. It's a credential through the AICPA as opposed to the Financial Planning Board. And then the Certified Divorce Financial Analyst, the CDFA, is specifically a certification that helps financial advisors help with the financial aspects of divorce. A registered investment advisor is actually a firm registered with the SEC or state securities agency. Just wanted to add that on too. Okay, next, Alex, think you're up.
All right, well, thank you, Judy, and thanks everyone again for joining us today. And just to reiterate, this is really meant to be an interactive webinar. So please ask questions. We'll try to address as many of them as possible. So again, you're looking for a financial advisor. You've determined that you have a need to reach out to someone. One of the things for you to understand, and this is not something that you need to be an expert necessarily in, and this is not a compliance related seminar, but you need to understand the difference between a suitability versus fiduciary standards, because again, that will have a very significant impact on the relationship that you're presumably about to have with your advisor. Now, again, we're not going to go in much detail here, but we'll focus on three, I would say, most important differences. Essentially, the approach, how the advisors are compensated, and essentially the goal of the relationship. So the fiduciary standard is essentially the golden standard in our industries for both financial planners and investment advisors. And it requires that you act in the best interest of your client. In most cases, really to determine what's the best interest, you need to spend some time to determine the unique objectives of your client. And again, any recommendation that you provide needs to be in the best interest of your client. Under the suitability standard, the approach may actually be somewhat, similar to what I just described, but the recommendation itself simply needs to suit the best interest of a client. So to give you, a general example here, once someone determines that you're, let's say, growth-oriented investor, they can suggest certain mutual funds that are growth-oriented. They may not be the best performing funds. They may not have the lowest possible fees, but at the same time, it's, it's suitable for your circumstances. Now, how the advisors are paid is also very important for you to understand. If you serve as a fiduciary, almost always, I actually don't know pretty much anyone who would be doing it under a commission arrangement, you would be getting paid directly by your client. This can be done in the form of hourly fees. This can be a fixed fee arrangement. This can be done in the form of, percentage of assets, assuming they're managing your investments. And we'll talk about that in detail actually in the next slide, but it's a direct payment essentially. With those that are under the suitability standard, usually, pretty much always, it's in the form of some kind of upfront commission or perhaps a trailing commission. In some cases, they would be willing to disclose it to you. In many cases, it would be reported on their website, but that's essentially how you would know. Now, the third difference, and again, it depends on how you necessarily want to approach this, is the ultimate goal of the relationship. When you work with a fiduciary, the ultimate goal is to form this long-term relationship with, between the parties, essentially. Under the suitability, very frequently, the idea is to essentially have a mutually beneficial transaction. There is nothing wrong with that, by the way. If you're looking to buy some life insurance, just to make an example, let's say you've determined that that's important for you, perhaps you don't really need to have a fiduciary who would be working with you. If you're looking for a long-term care policy, just to make another example, perhaps it's not really needed as long as you understand the nature of that relationship. Now, when you may, experience issues, and again, I will absolutely stay away from making any specific examples, is when that is not properly disclosed to you and you're essentially surprised by the outcome. An example of that, again, a general example would be life insurance companies. Over the past perhaps 5 to 10 years, they've hired multiple, many actually, CFPs to essentially serve their clients, and that's great. They're trying to enhance the service, the offering that they're providing to their clients. But what happens, again, they would meet with you. They would design a financial plan based on the circumstances that you're in. Perhaps it's going to be free of charge. Perhaps there's going to be some kind of fee involved. That would be called a hybrid arrangement. But the end goal of that is to essentially determine, what mutual funds, what annuities or other products would be marketed to you. So then you look at the end product of this, let's say, financial plan, and you notice that every investment you have is from essentially a single provider, and that may be somewhat surprising to you. So again, the bottom line is it really depends what you're trying to accomplish, but you need to understand that there's a pretty big difference between the two. So in terms of the compensation structure, and just to make it very clear, we will focus pretty much entirely on the fiduciary side of the equation. So for those of you who decide to work under a different standard, under the commission arrangement, you would simply ask the question, and they would presumably disclose to you exactly how that would work. Now, hourly fees. This was actually, I would say, it used to be very common. It's becoming, I would say, less common over the past 5 to 10 years or so. And essentially, the way it works in some sense, as the name implies, you would reach out to someone, they would discuss what services would be provided to you, they would disclose their hourly fees and the fees of their team members, and then you would essentially agree on the cost estimate and on the scope of the engagement. This is a great approach for people who need specific advice. College planning would be an example of that. This is great for people who perhaps prefer to do the work themselves, but they're looking for someone to give them their opinion on their, let's say, existing plan. It is perfectly appropriate for comprehensive planning when you essentially engage for a variety of different things, like, again, college planning, investment planning, estate planning, etc. But keep in mind, in many cases, you would be the one responsible for the implementation of the plan that the advisor would develop for you. In many cases, they would be willing to, of course, help you implement the plan, but in terms of ongoing basis, essentially you're the one to reach out and ask for additional advice if or when you need it. Some of the issues with this approach, well, especially when you work with a new client, it's frequently quite challenging to provide, let's say, a reliable cost estimate, because in many cases you just don't know exactly how much would be covered under the engagement. And again, as I mentioned earlier, there's usually limited post-engagement support, but it really depends on the advisory firm that you're working with. Flat fees. Under this approach, similar to what I discussed just a moment ago, you would reach out to someone, you would agree on the services that would be provided to you, and then essentially there's a flat fee attached for that service. That is actually not particularly common. Some people would do it, but that's not a very common way of providing the services. A more common is this so-called subscription-based model that is becoming more and more popular over the past, I'd say, 5 to 7 years. And essentially the way it works, you would reach out to the firm, and usually they would offer multiple packages to you, let's say lower cost, somewhere in the middle, maybe, let's say higher cost, dependent on your specific needs. And then they would be providing those services to you on this ongoing basis. So let's say the advisor would reach out to you semi-annually, or maybe you'll have some kind of checkup on a quarterly basis. Now, it's becoming quite popular. Some of the issues with this approach is perhaps limited customization. It's a great way to start, working with someone when you again have those ongoing needs. But once your situation becomes more complex, and let's say you don't fit into the model that they're essentially providing, it would be more challenging for you to essentially work with them. Now, percentage of AUM, or assets under management. I am inclined to say that's pretty much the most common approach. And essentially what you would be paying your advisor is based on the percentage of assets that they would be managing for you, or AUM. Typical range is somewhere between 0.5% to 2%, of course, depending on the amount of AUM. Now, one of the issues with this approach, out of the three at least that we discussed just now, this is the most complex. See, with the first two, with hourly and flat fees, well, you engage the advisor, you like the plan, but let's say you don't like it that much, you just don't reach out in the future, and that's pretty much the end of it. Or with flat fees, you just cancel your engagement with them. With the AUM approach, essentially you're transferring your accounts to someone for management, and usually there's an investment policy in place. In some cases, there's a financial plan that is essentially represented by the investment policy that they would design for you. So if you change your mind on that 6 months down the road, well, you can still do that. But again, all of those things that they're already doing for you, if you decide to leave it again, perhaps there'll be some impacts in the form of capital gains, just to make one example. So it's a more complex approach. Now, one of the things that you're not seeing here, but perhaps you're wondering, which one of the three is perhaps the most cost effective from your perspective, from the perspective of a client? And the answer to that question is really, it depends. It depends on your circumstances. If you're looking for you're looking to essentially check in with someone on an annual basis, well, chances are the hourly is the best way to go. You don't really need to do much else, and especially if you want to be involved, in your own finances, you have the time and knowledge to do it. Flat fees, especially the subscription-based model, is great for those who don't necessarily have that much, for the advisor to manage, but they have, ongoing needs for financial planning services. That is actually one of the reasons it was launched. You have this ongoing financial planning needs. And finally, with AUM, that is usually when you realize, look, I'm busy, I just don't have the time to deal with this. I essentially want them to handle most of it for me. And depending on their internal fee structure, which is something we'll discuss in just a moment, in some cases, you would actually be saving money compared to the first two approaches I just discussed. So short answer is, it really depends. So this, what you're looking at here, this is an actual, cost comparison that we prepared for one of our clients. Of course, we, edited it, for the purposes of this presentation. So essentially, you're making a choice. You're looking for a financial advisor. You interviewed ABC management, and they, disclose to you how they approach. They disclose their approach to you, and then you met with X, Y, and Z management, and you understand how they operate. So one of the common mistakes, and I would say it's a mistake that people make when they select their advisors, they focus only on the investment management fees or on direct costs. And this, by the way, applies exactly the same way if you're working with someone on the hourly basis. So in this particular example, the ABC management company is charging 0.7%. X, Y, and Z management is charging 0.8%. So if that's where you stop, well, presumably, you would go with ABC management. Now, ABC management uses a very different investment approach compared to X, Y, and Z. They use more actively managed funds. They use proprietary holdings. So the internal fees on the funds that they would be using to construct your portfolio are significantly higher than for X, Y, and Z. And in this particular example, they're almost 3 times higher. Now, one of the things perhaps you noticed we highlighted here in blue, X, Y, and Z management, it's an investment management firm, but they also specialize in financial planning. So when you work it with X, Y, and Z, those types of services would be provided to you as part of one package. There's no separate fee for that. And then finally, on the transaction fees here, we usually include that line here. Year 2021, they're becoming less and less. Brokerage firms are becoming more and more competitive, but it's still something to keep in mind. Now, here's one thing I'm just not sure how to necessarily say it. It would be very challenging for you to determine exactly, what internal fees your advisor is charging you. I will just say it as is. We use Morningstar Advisor workstation to do that. Essentially would enter each fund to determine the average fee. You can eyeball it, you can ask that question, but for let's say for an average client, it's hard to determine that. But keep that in mind. It's not only about the direct fees. So any, or let's say most or many engagements that you would have with your advisor, especially comprehensive ones, they would include some kind of investment advice or investment strategy. So these are some of the things to keep in mind. Every single advisor out there, if you go and visit their website, will most likely state that their approach, their investment approach is custom to your needs. I mean, pretty much everyone will say that. Now, when you actually have a conversation, when you interview those people, ask them exactly what that means. In many cases, what actually happens, they have this so-called models, conservative model, growth model, and let's say balanced model, and many more of them. And essentially the goal is to determine which one you would fit in and to put you in that model. Now, perhaps that's exactly what you need. Perhaps that's a perfect approach for you. But think about it. Let's say you have some so-called legacy holdings. You just inherited some stock from your grandmother, just to make an example, or you have some personal preferences. Exactly how would those personal preferences be accounted for if they simply put you in one of their internal models? Again, I'm not implying that this is a bad approach. Just make sure you understand that. Active versus passive. This will have a very significant impact on your investment experience with your new advisor. Variety of reasons. Actively managed funds, well, of course, in some sense, as the name implies, the goal is to outperform the market. That happens occasionally. Occasionally, it doesn't happen. So, over time, you may actually be quite surprised by the performance of those funds. Regardless of that, almost always, or at least frequently, they're more expensive, which is one of the reasons we showed you the previous example. In many cases, especially for taxable accounts, they're less tax efficient. They're inherently less tax efficient than passive investment strategies. So again, when you have that conversation, ask that question. Are you an active manager, passive, or perhaps many people, by the way, they use both. So you want to understand that. Proprietary versus publicly available options. In some sense, similar to what I just described, but the idea behind it, again, you work with advisor A, B, and C, you're happy with them for 3-5 years, then at some point you decide to leave. If they use proprietary funds, chances are you will not be able to take them with you if at some point in the future you decide to leave. If it's a taxable account, again, you would most likely need to liquidate those holdings, and maybe they're good performing holdings, but that would generate some tax consequences for you. And then more of a general, kind of like a big picture approach, there are thousands of options available to the public in the form of retail class shares, institutional class shares. They're much more transparent. Anyone can pretty much see how those funds operate. Why exactly would someone want to include those proprietary options in your portfolio? Ask that question. Tax efficient strategies, some sense I talked about that earlier. If your engagement is investment based, that's what you're looking to accomplish, ask exactly how they would control essentially the tax impacts of their decisions. Would they be willing to harvest losses for you in real time? Let's say when markets are down, and that creates an opportunity to do that. When they make changes to their portfolios, will they be paying attention to what's happening with you, with your particular situation? Or would that be just across the board, we're selling funds A and B and C, and we're going to sell them every single portfolio? What are the impacts? Socially conscious or ESG investing. For perhaps some of you who are not familiar with this approach, it doesn't matter. But if that's something that you're interested in, ask that question. Is this something that you do? Is this the type of services that you provide? And exactly how would you actually be implementing it? And then finally, I would say perhaps the least important of the 6 points that were covered here, but still something for you to know. If your advisor is working with one of the national custodians, and I'm not going to mention any names here, chances are you'll be perfectly fine. You'll have access to many options, and chances are you'll be paying the lowest possible transaction fees. If they go with a smaller custodian, well, you'll have less options available to you, and in some cases the transaction fees would be higher, but it's not really a big deal in 2021. So the size of the firm. So this is, of course, one of the decisions that perhaps you would have to make upfront before you even start, interviewing different firms. And there is nothing wrong with essentially interviewing both. And one thing I do want to make clear here as we discuss this, you can certainly look at it entirely differently. So the 6 bullet points that apply to large or national firms in many cases would apply to small and mid-cap and mid-sized firms, and vice versa. These are just some of the most common observations that we've been making. So with large or national firms, you pretty much know all of them. I don't need to mention any names here. One of the advantages of working with them, they've been doing this for a long time, they have very defined service models. So you reach out to meet with someone, you tell them, this is my situation, these are my needs. They'll be able to almost precisely tell you how they would be assisting you. So people tend to like that. Since they're large, national firms, they tend to have significant resources and, of course, access to technology. Why is that important? Let's say you work with a relationship manager at, national firm A. Perhaps there's an investment advisor that is involved with you. Perhaps there's an associate or administrative person who handles your daily requests or weekly requests. Now, at some point, you also reach out to them and say, I need to refinance my mortgage, or I need to get a business loan. Many of those firms, they would be able to provide access to those resources to you. In some cases, they would also be able to do it at a discounted price. Team-based approach, that's something for you to keep in mind. When you work with those firms, almost always you'll be working with a team, usually 3 to 7 people. And the quality of the services that you would be receiving would depend greatly on the experience and skill set of that particular team. So national firm A that operates in, let's say, in the DC area, national firm A that operates in, let's say, Florida, the quality of their service may be quite different. Some of the issues, perhaps more common issues with those types of firms, is high turnover. As Judy was, in some sense mentioned earlier, with larger firms, it's relatively easy to get in, relatively, of course, but at the same time, people tend to move out at a much faster rate. One example I have, I just really remember that one of our clients, he started working with someone and they changed the advisor on him actually twice in the same year. He wasn't all that thrilled about that. Now, in terms of the national firms, pretty much always there's a corporate office that essentially determines the strategy for that firm. As a result of that, quite frequently, their targets or their compensation is based more on the client acquisition goals versus client retention targets. This is not something that is necessarily public. This is not always publicly available. They don't have to disclose it to you, but keep that in mind. In some cases, it's not up to the advisor who is working for this firm to determine exactly how they would be servicing their clients, which leads me to essentially the final point I wanted to make here. They tend to have limited independence. So yes, let's say you've been working with advisor John, let's say here in Bethesda, national firm A, but essentially John here has to implement what the corporate offices are telling him to implement. He will have some options, absolutely, but usually their choices are limited to essentially, what the corporate offices are telling them. Small or mid-sized firms, and here we thought we'd put them in one category, and really the range here is between, let's say, 1 person to something like 200 people, understanding this is a very wide range. In this industry, by the way, you're just not going to see very many companies that have 500, 600, 700 people. Usually it's somewhere between 1 to, let's say, 200, maybe 300, and after that they become quite large. So smaller teams tend to be more stable. They would usually interact more with their clients. And also, which I think is very important, they tend to interact more internally. And that is important if you're receiving multiple services from one firm. Let's say you reach out to them for financial plan, investments, taxes, estate planning. There's usually more internal interaction. Now, they're smaller, and in many cases, they're more or fully independent in their decision making. So as a result of that, they can really tailor their advice to your specific needs. Again, it's not always the case. Some companies have very limited policies in terms of what they do, and perhaps there are good reasons behind that. But in many cases, they can really tailor it to your specific needs. Now, if you decide to work with a very small team, an example of that would be, let's say 2 advisors and 2 associates, chances are you'll have access to relatively limited resources. Many of those companies, they're specialists in their fields, and if that's exactly what you need, that's a perfect match for you. But if at some point you realize that you need more than that, well, perhaps they'll refer you to someone else. You will be working with someone else. Is that the most efficient way of doing this? To communicate with sometimes 2, maybe even 3 different advisors, and also, is that the most cost-efficient way for you to basically conduct your business? Now, here, this may be a little surprising to you, but if you decide to go with a small or mid-sized firm, perhaps you should do more due diligence on what they exactly do. Now, you should do your due diligence regardless of the firm that you're working with, but in this particular space, the difference can be dramatic. You have 2 teams operating Bethesda, more or less the same type of firm. Let's say each firm has 5 or 6 people, but the approach they would take to essentially advise you in some cases would be entirely different. So make sure you do, I would say, more due diligence if you're working in those types of firms. And finally, which has really been a big issue on this part of the industry, is relationship continuity. Again, mostly applies to smaller teams. Again, perhaps they made their decision. They don't necessarily want to grow that much. And at some point, well, people either decide to stop doing what they're doing, or perhaps they retire. If there's no continuity in place, well, what happens with your relationship? Can something like that happen with a national firm? Well, absolutely. It's just usually with those types of firms, there's a plan in place ahead of time, and when people are transitioning. With small firms, every so often you hear a story, it's like, wow, someone just basically retired and moved out of the area. So keep that in mind. And then finally, with Robo Advisors, for those of you who are perhaps familiar with them, you don't necessarily want to spend much time on it. They are, simple, low cost, financial/investment services. They provide easy access for you, especially if you don't necessarily have much saved. In many cases, they require no account minimums. This is a great way to get started if, again, you have basic needs and you don't necessarily want to do much on your own. You just want someone to help you get started. Robo Advisors are good. Many of them would be a good choice for you. In terms of, again, the longevity of that relationship, most of them, they would not necessarily focus on any complex issues. So it's mostly, again, for basic services. All right, so one of the slides here, and we'll just go over this actually quickly, in terms of the location. Well, some of this is obvious, right? How important is it for you to meet with someone in person, right? How frequently are you going to meet that person? See, in this pre-COVID environment, if we want to put it that way, it's very important for people to work with someone locally. And I still believe that's the case, but make sure that's the case for you. Again, what is your comfort level with technology? Again, for those of you who participate in this webinar, I'm assuming you're comfortable with it. What choices are available in your area? Especially if you live in a remote area, perhaps you would be better off working with someone outside of your zip code, especially, again, if you're meeting with them mostly through video calls. Advisor specialty in your personal circumstances. Yes, you have this great team that operates locally, but perhaps their specialty is not what you need. So the point here is that, again, in this post-COVID environment, and yes, things are moving more and more toward this video meetings, perhaps you should take a more comprehensive approach versus just saying, I'm going to limit it to my zip code or perhaps my state. And then finally, the top 5 questions we recommend that you ask, regardless, again, of your circumstances, and feel free to add other questions here. Again, when you're interviewing someone, are you a fiduciary? And in our opinion, this is actually one of the most important questions to ask, because that would essentially determine the nature of your relationship. The answer to that question is yes or no. There's nothing in between. If someone says, I'm not a fiduciary, but keep that in mind. What services do you provide, and what is your specialty? Make sure you understand that. If you have a general financial planning needs, perhaps that's not important. But if your questions are more tax or perhaps investment oriented, perhaps you should have an advisor who has experience doing that. Describe your team and who would be the lead advisor. People do not ask that question, and very frequently they regret not asking that question. Very frequently they assume that the first person that they're speaking with would be the one that they would be working with. And in some cases, that's exactly that. In many other cases, you would see that person, maybe a few times a year, but you would mostly be interacting with that person's team, which is, by the way, how many firms are structured, large or small. So make sure you understand what team that you would be working with. What is your investment approach? What is your investment philosophy? Do you use any proprietary products? And here it's really up to you in terms of how far you want to take it, in terms of how important it is for you that they address these questions. Finally, describe your compensation structure and asset minimums. This is where the answer needs to take less than a minute. It needs to be clear. It needs to be transparent. If someone starts saying, a lot in terms of how they get compensated and you don't understand it, well, make sure you do it, because again, you can be surprised. And we talked about a couple of examples here. So that is what we have for you today. And before we open it up for questions, again, we have a couple of webinars coming up on February 23rd. We'll be presenting on Medicare and Medicaid for those of you who are interested. And then on May 25th, we'll have a certified nonprofit accounting professional training. We have a resource center, coronavirus resource center. Feel free to check it out. This is especially beneficial for business owners. And with that, we will open for questions. So if you have any, please ask them in the chat box. We had several questions that were submitted to us prior. So I guess we'll start with the ones that were submitted to us prior. So here's the first one. For non-business owners or individuals with not high-paying jobs, when would you recommend a financial advisor? What do you think, Judy? What do you think about this one?
Well, so I would go back to the events and transitions in life that we talked about. And there are certain times when definitely you would want to seek a financial advisor. For example, if you're considering getting married, starting a family, certainly getting divorced, I would absolutely always seek a financial advisor when you're getting divorced. Approaching retirement, and again, like I said, preferably 10 to 15 years out beforehand, so that any tweaks that need to be made can be addressed at that time. Inheriting wealth, of course, that often triggers the need to approach a financial advisor. Death of a loved one, passing to the next generation, all of those items we talked about in the beginning regard to the twists and turns in the game of life. And if your resources are limited, you could consider the hourly approach. Obviously, we also had some questions about is there a minimum amount, again, from a vesting standpoint before you start approaching a financial advisor. But I think if anything, a takeaway from today is that financial advising is much more than just reviewing portfolios and making recommendations in terms of investment strategy. It's much more comprehensive to address holistically all parts of someone's financial well-being.
That's absolutely right. And Judy, in some sense, you just addressed the next question we had. Is there a minimum amount one should have before looking for a financial advisor? So just to, again, reiterate what Judy said, the answer is absolutely no. And in many cases, actually, you'd be much better off establishing a relationship with someone prior to essentially having more funds available for investing. And again, there's just so much more to this than saying, you know, this are the investment options and this is how we'll be managing for you. You know, again, a high quality financial advisor can do much more for you than that. Couple more questions here. What suggestions do you have for refocusing one's financial planning post-divorce, including college for kids? Question mark. Especially now that the financial pie is solely in my income now and no longer a dual income household. What do you think about this one, Judy?
So the first thing is I would hope that the planning for college education of kids would have been addressed during the divorce, because once it's post-divorce, it's a little late. You know, that really should have been taken into account when there's division of assets and a set of child support and alimony if that applies. But I would say, again, it's kind of like getting started again as a single person or head of household, where, you know, first thing you have to do is develop a budget and set your goals and understand how to live within your means, and within that, also budgeting for future events such as college, maybe healthcare issues, maybe retirement. You know, so a financial advisor could help you not only just determine where are you here and now, but where do you want to be 5, 10, 15, 20 years from now, and how do you get from here to there? And that's really the beauty of being able to sit down and do the show and tell, and let somebody else, you know, have an objective look at your situation. We've had, I mean, to be honest, we've had to have some frank conversations with clients where, you know, they're not going to be able to do what they had hoped to do. You know, they really have to think out of the box and look at, you know, maybe selling the house, maybe downsizing, maybe moving to a lower cost state. But that's what we're here for. Is sometimes, you know, sometimes clients need to be told that, you know, there are other options and need to be flexible and understand that, you know, the consequences of the choices, so that eventually, you know, they land on their feet and they're going in a direction that they want to.
Right, and just to add to that, and that's not necessarily what was asking this question, but in some cases it's the opposite of that. People, you know, come to us and they're very much worried about the future, you know, perhaps the retirement or any other objective, and then you assess their situation and you basically tell them, well, you know what, you're actually doing much better than you were expecting, you know, when you reached out to us. So there's that outcome as well. But, you know, Judy, I would say with Judy's example, it's probably more frequent than what I just mentioned. Okay, so here's another one that's, you know, it's perhaps not directly related to this presentation, but we'll be happy to give you a general response. The pros and cons of leaving a 401k plan when retiring or rolling into a Roth IRA, some, all, etc. What should these funds be invested in upon retirement years? So would you like to address this one, Judy? Would you like me to do it?
No, you go ahead.
So this is, again, a very specific question. So, you know, specific answer would really depend on your circumstances. One thing to note here, just the way I'm reading this question, if you have a 401k account, and I'm just going to work with an assumption that it's a traditional 401k account, and you cannot really roll it over into your Roth IRA, because if you do that, that's actually a Roth conversion. That's a fully taxable transaction. Usually, when someone is in that situation, we would suggest that they do a rollover into a regular or rollover IRA, and essentially make that decision later. Of course, your tax circumstances, current and future, would be a very big factor in making that decision. All right. For some of our clients, actually, that, let's say, retire at the age of 67, just to make an example, or 68, they have 3 to 4 years prior to their age 72, which is the required minimum distributions age. So that creates this 3 to 4 years of, I refer to it as artificially low income years, when you can actually do the conversion. Maybe not full of your entire account, but perhaps a portion of it. So it really depends on your circumstances. And then the second part of your question, what should these funds be invested in upon retirement? Again, it really depends. I would absolutely stay away from making a general observation and saying that you should be investing more conservatively. That is simply not always the case. Perhaps you have a pension in place. Perhaps between your pension and Social Security, more than, let's say, 3/4 of your income is covered, and your investment choices, they don't necessarily have to be that conservative. And the reason I'm addressing this question this way is because that's the most typical advice that you would receive. Someone retires and automatically needs to invest more conservatively. That is simply not always the case. One more question, and again, if you have any, please type them in the chat box.
I think we have a lot of people that called in on the phone, so they might not have access to the chat box. Does anybody want to unmute themselves and ask the question?
Please do, and also we will not mention your name. I know this is privacy issues. When we address your questions, we'll just read it, but we will not mention your name. So keep that in mind.
Judy and Alex, let me just quickly cut in here. I did just open up the option for people to unmute themselves. So if they've had trouble up until a couple of seconds ago, they should now be able to ask their question.
All right, so I guess before we do that, there's one more question, and actually there's two. One I will just acknowledge here. It's a great question from someone about her daughter. Her daughter is going to college, and it's about 529 plans. If you're listening, please reach out to Judy or myself with your question. We'll be happy to address it for you. It's a very long question. It's a very good question. And it's not necessarily directly related to this presentation, so I'd rather address it for you offline. So final question here. What is your suggestion on investing in stocks, mutual funds, and real estate? Question mark. Which one yields more return over time? Question mark. How much percentage would you recommend to invest into different categories? I guess it's really what percentage would you recommend to invest into different categories? Thank you. Judy, would you like to cover this one, or should I?
You go ahead.
So again, very specific questions, but happy provide a general response. The three categories that you mentioned are very different. Investing in stocks, by the way, or equities in general, you can do it in the form of individual stocks. You can do it in the form of ETFs or mutual funds. So it's a category by itself. Same goes for mutual funds. They can be more aggressive, more conservative, or perhaps balanced funds. Real estate, well, I'm assuming in this case you're referring to tangible real estate, is an entirely different animal. For the first two things, investing in stocks and mutual funds, I think of it more of a passive exercise, and I understand how some of you would disagree with me. When you invest in real estate, it usually requires more, not necessarily active management, but you have to really know what you're doing. And of course, you need to determine the location when you would be doing that. Which one yields more return over time? Again, it's hard to directly address that question because it depends what stocks, what mutual funds, what real estate you purchased. With stocks, well, over time, growth-oriented stocks tend to outperform value-oriented stocks, but not necessarily in the short run. With mutual funds, again, it depends what type of mutual funds. And with real estate, well, it's location, 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 right? The performance that you expect in the DMV area is perhaps not going to be the same that's somewhere down south, right? So you have to be careful with that. What percentage would you recommend to invest in different categories? It's a very tough one. It really depends on your circumstances. We do believe that pretty much everyone should have some in investments, right? Meaning in mutual funds, but what percentage of your wealth would really depend on your circumstances.
And that's specifically what financial advisors do. They'll sit down and actually go through, your individual risk tolerance, and even, prod you with, well, what if the market drops 30% like it did in March of 2020? Would you be picking up the phone and say, sell, sell, sell? Or would you be the type that could say, okay, I can hold, I can bear this out. So, we have a fiduciary responsibility to make sure that, you're not deceived in terms of what you're getting involved in, that whatever investment policy is adopted, that you're on board, and that we agree is appropriate for your circumstances, such that you can, not have sleepless nights or worry, given your risk tolerance.
That's right. Well, so this is what we have for you. It's actually almost 1 minute after 12. So
thank you very much for attending our webinar. We love speaking to you. Hope you'll tune in for our Medicare and Medicaid webinar later this month. And if you have any questions that we didn't answer, feel free to reach out. Alex, our emails are there, and so are our phone numbers. Love to hear from you.
Absolutely.
Have a great day. Thanks, everybody.
Thank you, everyone.
All right. Bye-bye.